Hi class, this video is going to run through a summary of all the elements that you might be asked to do in Unit 3 Area Study 2. So this is a SAC revision video that will cover a number of key topics as briefly but as completely as possible. What will this video cover? Really, there are a few key chapters in our textbook that we've worked on for a number of times that you know will be part of this SAC, so they're part of our summary. Firstly, we will ask you to determine profit. How do we determine profit in the world of debits and credits? We close revenue and expense accounts to our P&L summary account, so we're going to cover that process. We're going to cover the impact of profit and drawings on the capital account and this process of closing a P&L summary account. We will then move, after profit has been determined, how we actually report that to make it understandable, thinking about our characteristics and assumptions. Profit is important, but also is cash. Cash and profit are different, so we'll go through how to make a cash flow statement. And quickly and briefly, we'll explain a number of KPIs, I like to think of them, that we use to control the management and look at our management accounts, and we'll go through that as well. This video is really going to focus on processes, but also on some really quick and easy sheets, things to remember to help you be able to do this, because we're asking you to remember a lot of things. So if we think about profit and determining profit, we know that profit is revenue minus expenses. And by now, you've become really good at just identifying those accounts that are revenue and expenses. But if you get stuck, or you're asked in a question to define revenue or expenses, or define why you classified a certain account as revenue or expenses, remember that actually is 3 things that need to be ticked off for each of these elements. For something to be a revenue, even though we are now really good at just identifying it, actually 3 things need to be true. It must be an inflow of economic benefit. It must result in an increase in assets, or sometimes a decrease in liabilities, and also an increase in owner's equity. That is why sales are revenue. There is an inflow of economic benefit. It increases the asset of either cash or accounts receivable, and importantly, it doesn't impact any other asset. It doesn't impact liabilities, so if we think through our accounting equation, it must increase owner's equity. An expense also has 3 things that need to be ticked off. It must be an outflow or consumption of economic benefit, a decrease in assets, that leads to a decrease in owner's equity. So always keep coming back to that, and remembering capital contributions and drawings are never part of profit. These are separate activities. So if we come back to determining profit, we actually need to, when we determine profit, go through the process of closing ledgers, because we live in year 12, the world of general journals, general ledgers, and debits and credits. So when I say closing the ledger, what I'm saying is that we're going to transfer all balances from revenue and expense ledger accounts to a special account called the profit and loss summary account. This is where the profit can be calculated, and for those that are in my class, you know I love sport. I think of the profit and loss summary account as the scorecard. We are transferring all the results from our revenue and expenses to our scorecard to work out if we have profit. Why do we do this? Revenue and expense accounts should be closed off for 2 particular reasons. Number 1, we do it to determine the profit or loss for the period. So we're doing it to determine the score of our game, the net profit or loss. Importantly, we're also doing this because we need to return our revenue and expense accounts back to what we call a 0 balance. Because ultimately, next match, if we continue the sport analogy, we need to start the score again. We need to start recording revenue and expenses for the next period to work out our profit for that period. And we need it to be 0 at that stage. So we think about this scorecard analogy. The profit and loss summary account is a temporary account used to calculate profit or loss, remember that word temporary, and it will look something like this. This is your scorecard of a P&L summary that has had revenue and expenses closed off. I bet even if you have not done determining profit and closing ledgers, or you've just started it, you can tell me by looking at that what you think the score is, whether we made a profit or not. And that score is we made a total net profit of $3,000 because you can see in the cross references revenues were $10,000, expenses were $7,000. So we need to become experts at this process, but this is ultimately the process that we're trying to end up to. We've determined net profit, our revenue expenses are back to zero, and we have got somewhere in our scorecard that we can actually determine profit. So there is a flow chart on how this works, and I'm going to go through each of these, but I'm not going to go into this slide that much, but you might pause your video and have a quick look just because this is the process that we do. The first step we do is we have to learn how to close revenue and expense accounts. This is a pretty busy slide, but we're going to go through the process. The first thing you need to remember is, let's start with revenues. At the end of a period, revenues are going to have a credit balance. Remember, it's very rare for revenue or expense accounts to decrease, and they increase by credits in revenue. So we're almost always going to have a credit balance of a revenue account. And one example would be this sales revenue, so sales ledger, where you see we have a credit balance of $10,000. At the end of the month, how would we make this account zero? If we have a credit balance, the way we zero that is we do a debit of the same amount as the balance. If there is $10,000 on both sides of this ledger, ultimately it has been zeroed. How will we do that? In our general journal. So here you see at the end of the month, June 30, we've done a debit for sales revenue. That will mean that general ledger is balanced. Both sides are the same. For a debit, if we do a debit in double entry accounting, we have to do a credit somewhere. This credit goes to our scorecard, our P&L summary. And if you think back to the P&L summary account that we just looked at, you might remember there actually was $10,000 of revenue. If we do a general journal, what do we have to do? We have to post it to our general ledger. But I do want you to understand this general journal, it's probably the most important bit. To close off this sales revenue account, a debit entry of $10,000 was required. We then post it to our general ledger and we just follow the instructions. We're going to pick up the debit for sales revenue and put it on the left-hand side, and our cross-reference is P&L summary because that was our credit. At the end of the period, expense accounts will have the opposite of a credit balance. They will have a debit balance. And we know that there is often always more than one set of revenue or expenses, so let's do a bit more of a complicated one. For example, I'm thinking of 3 expenses: cost of sales, advertising, and wages. If you add them up, I'm sure you can do that quickly. We have $7,000 worth of expenses. How do I make these ledger accounts zero? By doing a credit, because then they will balance. So I do that via my general journal. You can see I now have put a credit for each of the expenses that will make each of them respectively zero. So cost of sales, $4,000, advertising, $2,000, wages, $1,000. These will now have zero balances because they'll have the same amount on each side. And I need to transfer that to my scorecard, my P&L summary, as a debit. Now there's not enough room here, but this would then go to our general ledger. So what has happened here? We've closed off each of these accounts via a credit entry, and this goes to our general ledger. And that is how you close credit, revenue, and expense accounts. And that's quite a complicated process which will involve a bit of practice. What's the thing to remember? To close revenue, I'm going to do a debit. To close expenses, I'm going to do a credit. And the P&L is the opposite entry. we have now done this so the revenue expense accounts have a zero balance, and the amount of our revenue and expenses has been transferred to our P&L summary, remember our scorecard, so we can now determine profit. So that's a complicated process. It might be time to pause and reflect, but that we will keep going because after that we still have a few more steps to go. After we've done our transfers or closed our revenue expense, we actually need to determine profit. We need to determine profit by analysing our profit and loss summary account. So if we have a credit balance, revenues will exceed expenses, because remembering this is, if we go back, we are going to close revenue to debits and close expenses to credit. So the opposite goes to our P&L, which means revenues go to credits in our P&L summary. So if we have a credit balance, we have more revenues than expenses. That sounds complicated, but I think it'll be clear when you look at our example. If we have a debit balance, our expenses exceed revenues and we have a loss. So if we look at this one, we can see that we have our credit balance. Our right-hand side has more than our left-hand side. Our revenues exceed expenses, and our cross-references give you a hint. Now, you might remember a key characteristic of the profit and loss summary account. It's temporary. It's just our scorecard for the game. We need to turn it off to start again the next month. So how do I make this P&L summary account zero? So it's temporary. If it's zero, it disappears. I need to make it balance. The only way I can make it balance in this case is to make each side the same. So I need to put $3,000 on my debit side. How do I do that? Via a general journal entry. Where does this other part of it go? It goes to our capital account. Why capital? Because capital reflects how much our business is worth. If we have a profit, our business worth goes up. If we have a loss, our business worth goes down. And that's the process that we're doing. So we have in effect transferred profit to our capital. And you might even remember to our balance sheet in our owner's equity capital section, we actually report where our profit goes. So this is all linking in all of our reports now. So our profit and loss summary, as you can see now, is balanced. It has done its purpose. Congratulations, P&L summary. You are no longer needed. It has served its purpose. We have reported our profit to our capital account. Now, finally, and this is the final process of a complicated process, there is one other aspect potentially of a business that might reduce how much our business is worth, and this is drawings. So the final step is to transfer drawings for the period to the capital account to reflect, in this case, our business worth go down by a little bit by our drawings. So to do this, we are going to reduce our capital. Capital is an owner's equity account, so a debit reduces owner's equity. In this case, $1,000. We've pretended it's $1,000. And we've done a credit of our drawings. The owner's capital account is hence updated for the profits and its drawings. And it will look something like this. This is a complicated ledger, but you can see on June 30, we started off with a balance of $50,000. That's assuming that this is a yearly process. We have then transferred $3,000 of profit to further increase its capital, but we've had $1,000 of drawings. All the rest of this is purely a recognition that capital is an owner's equity account. And what do we do with owner's equity accounts? We balance them at the end of each reporting period. So we now have a July 1st balance of $52,000. And that is a really complicated process, and it might be time to pause. The rest of this video is going to go through a bit more quickly now that we've determined profit, how do we report this in an income statement, and then how do we consider the impact to cash. If we think about our income statement, we make an income statement even though we've already determined profit because we want to analyze it. We want to be able to work out, as good accountants, what is going well with our business, what is not, and what advice can we give to improve it. And a report like this, and you can see your income statement there, allows us to do that. It creates a number of separate categories that allows us to analyze it. So your task is really to be able to understand what these sections mean and know which goes in each of them, because then all you're doing is identifying revenue and expenses and plonking them in where they go. So let's go through all of these sections. The first section is going to be your net sales. Net sales is where we're going to record all our sales, cash and credit, and also reduce our sales return if needed. We then will come to the section of cost of goods sold. Cost of goods sold are an expense, so it is a less. And this is where we're going to include cost of sales and also any other expenses incurred to get the inventory into the business and into the location ready for sale and condition. So this is going to include all the expenses that include the word inward, because it's getting it into the location, as well as a few others, and you'll have to think this through, like modification, buying expenses that make the change how it's going to be sold or getting it into the business. So there could be a number of these, and the practice will help you identify them. We then are able to work out our gross profit, which is net sales minus cost of goods sold. We will then potentially have an inventory loss or an inventory gain, which is going to adjust our gross profit. It will be plus inventory gain, or in this example, an inventory loss. So it's an expense, so it's going to reduce our gross profit, hence less inventory loss. Finally, we're going to list all of our other revenue. This is going to be any of the other revenue elements that aren't sales. Interest revenue, discount revenue are two very common ones. And then we're going to reduce less all of our other expenses. And you can see the good example, cartage outward, not part of cost of goods sold. Cartage inward is part of cost of goods sold. And from there, we'll be able to work out our net profit. So you're going to need to do a bit of practice, and we'll go through the sections in a second. But just remember, maybe the hardest bit here is identifying which goes in where. So you're going to need to know the sections. And you might want to remember that cost of goods sold might include things like, always includes cost of sales, but could include things like cartage inward, freight inward, delivery charges, as well as customs duty and buying expenses. If we look at this a bit closer, these are the sections. First, we come to revenue, and you can see this one does less sales returns. We will then less cost of goods sold, including 2 here to make our gross profit. We will then either less inventory loss or add inventory gain to get our adjusted gross profit. We will then, after we get our adjusted gross profit, add any revenue that is not a sale, so add any other revenue. And finally, less our other expenses to get our net profit. And that is ultimately what we're going to be asking you to do. Determine profit using closing entries, transfer it to capital, and then come up with an income statement which allows it to be easily understood. We then come to cash flow statements, which is a different category, and it's important because we know cash is not the same as profit. Profit is really important, but often something that is often a bit neglected is cash. Why is cash important? Because it's how you pay for things, especially those important debts that are going to create business troubles if you don't pay them, such as your bank and your credit suppliers. So we need to find a way to report on our cash, and we need to have a report that allows us to analyze it. And we do this by separating into 3 separate activities that you can see on this sample: operating, investing, financing. What do you notice, or what do you remember about cash flow statements? Firstly, we always list our inflows first, and we add them. So cash inflows are good, they are positive. And then we work out our cash outflows, and these are negatives, and we show these by brackets. We have some unique terms to remember, and these are details that are not general ledger names, and it's important to remember them. We're going to work out our total cash, we call this net cash, for each of our three key categories: operating, investing, and financing. The total is just all our inflows added, subtracting all our outflows. The overall increase or decrease is going to be the net impact of all three. So for example, this one, 74 minus 4 minus 25 gives us a net increase of 45. And finally, there will always be somewhere in that question that tells you what cash you held at the beginning of the period. So you might have to be a detective to find it. And this will then determine, plus what you made in this period, what is the end cash at the end of the year. So for example, this one, we had a really good year, so we made $45,000 of cash, but we started with a $12,000 negative, a bank overdraft, hence our end cash is $33,000. So that's what you need to be doing, and that looks complicated. So we need to come up with a way to remember how to do this that is simple and easy. How do we do this? We need to remember the cash flow is made up of three classifications. Operating activities are our cash flows from day-to-day trading operations. Investing is cash flow relating to the sale and purchase of non-current assets. Financing activities relate to the changes in financial structure. Important definitions to know, but there is an easier way to do this when you're actually just being asked to make a cash flow statement. But if you're asked, why did you classify something, you're going to need to know those definitions. What I think the easiest way to do it is when you're classifying, and what I mean by this is actually going through your set of transactions in a trial balance or a ledger, you're looking for four key terms. If we think of investing activities, you're looking for non-current assets. They could be lots of examples, but you're looking for something you identify as a non-current asset. Computers, equipment, shop fittings, premises, building, anything like that. These could result in an increase or a decrease in cash. If we sell a non-current asset, our cash goes up. It's an inflow. If we purchase a non-current asset, our cash goes down. It's an outflow. So your first term is non-current assets. Your three other key terms all relate to financing activity. So if you see anything of these ones, you know instantly it has to do with financing. If you see the word loan, it will either be an inflow or an outflow. Inflow when we take out the loan. Taking out a loan increases your amount of cash. And an outflow if you pay back the loan. Capital, our third term, will be when a business owner gives us cash. That is clearly an inflow. And drawings is when our business owner takes cash out. That is an outflow. These are your four key terms: non-current assets, loan, capital, drawings. Operating activities is everything else. So if you remember those four terms, you can then follow three steps to make your cash flow statement. What are these steps? Firstly, however you've been given in the information, try and categorize the items. Are they cash or non-cash items? If the part of the transaction has nothing to do with cash, just ignore it. You don't put it in the statement. You're then going to go through all your information and categorize the items. Is it operating, investing, or financing? Just put an O, an I, or an F next to it. And remember, you only need to look for four key terms. So you either can do it as a list or just ignore the operating and look for those keywords: non-current assets, investing, loans, capital or drawings, financing, and finally, just categorize if they're an inflow or an outflow. If you do all that, then you're just plugging it into a template, and you will need to know the template, know what it looks like, but that's actually the easy bit. And then we come to the last bit, management accounts, which I'm going to do pretty briefly. When we are making our accounts, we need to manage our day-to-day activities, and we want to be as efficient as effective of managing our core business. What is our core business? Buying stuff from suppliers, keeping it as inventory, and then ultimately selling it. And if we sell it on a credit, collecting that cash. We want this process to be as efficient or as quick as possible. We want, if we're spending cash, that cash to come back as quickly as possible. And we have 3 things to analyze because of that. Firstly, we have inventory turnover. We're thinking here, how fast in days can a business turn its inventory into cash? How quickly will we turn our inventory into cash? We have a formula, and I'm just going to put that up on the slide and not even talk about it because that will be clear in a second. But you might be told your inventory is 32 days. That means on average, once you buy your inventory and it's in your warehouse, in your business, it takes 32 days for you to sell it. Now, that number is almost meaningless unless you understand the business, but we can look for trends. So do we want this number to go up or down? I hope you can identify that we want that number to go down, because then we're selling our inventory faster, and that's ultimately a good thing. We also have accounts receivable turnover, which is how fast in days can a business turn accounts receivable into cash. So if we sell something on credit, we still don't have cash yet, and we want our customers to pay us back. Again, there is a formula that I'm not even going to talk about, and that will be clear in a second. But we need to know how fast we turn our credit customers, what they owe us, into cash. So if we have a customer, for example, a business that has accounts receivable turnover as 22 days, that means when we make a credit sale, on average, it takes 22 days for them to pay us back. Do we want this number to go up or down? I hope you identify that we want this number to go down. So inventory turnover, accounts receivable turnover, we are doing better at managing our business if these go down, because we are getting our cash quicker from our sales from after we get our inventory, and that's a good thing. One that is a little bit harder is accounts payable turnover. This is not about getting our sales, this is how fast in days it takes us to settle our accounts payable, how long it takes on average for us to pay back our suppliers. Again, a formula, but thinking these through, do we want how fast we pay our suppliers to be quick or slow? This one is a question mark. You're going to have to think this through. It might be a bit weird, but there is advantages to not paying our suppliers quickly. We get to keep the cash, but you don't want to do this for too long because it's going to annoy your suppliers. So to be technical, you might look at the credit terms. Remembering, all your suppliers will tell you how long you must pay, what the maximum amount of days you can wait until you pay them. It might say N-30. Typically, we want to get as close to that day as possible before we pay them without annoying them. So you're going to be given this information and you'll analyze trends to talk about how well your business is running your accounts. And guys, this is a long video because we have a lot of stuff to revise and some complicated processes. This is all you need to know for outcome 2. So now your TAM is to practice, practice, practice. Remember those little tips on some processes to make your reports, and you will then in no time be celebrating a successful completion of your Unit 3 in accounting. Well done.